Joining us now, Sri-Kumar Global Strategies President Komal Sri-Kumar. Sri, thank you very much for being here. Just curious if you agree with Paul Tudor Jones on his assessment about the current situation with rates and its potential to tip us into a recession.
Leslie, thank you for having me. And in terms of agreeing, I would agree with Paul Tudor Jones in terms of a recession coming. That has been my baseline forecast for quite some time, but not because of higher yields. I disagree that the yields are going to head much higher. I think before they head much higher, give it a ceiling of 5% for the 10-year, something is going to break within the system. My top candidate is the US banking system. Recall what happened in 2007, 2008. So already bank deposits are under pressure, moving over to treasury bills and money market funds. Even some of the larger US banks have suffered a drop in equity prices. I think all of those are going to result in what you call quote unquote credit event. Whether it comes from more bank failures like we saw in March, or whether you see it in terms of a commercial real estate collapse, or finally, whether you see it in terms of a credit crunch, the Fed is soon going to have to shift over from inflation mitigation to what it calls saving the system, and that will bring the yields down, Leslie.
I would love to follow up on that, because one of the key reasons we've seen such pressure on bank stocks lately is just additional regulation requirements, especially for some of the larger banks and the larger regional banks, to hold more capital in the event of any kind of issue on that front. So, in terms of an overall credit crunch, where do you see that coming from? Is it the bigger, most capitalized, systemically important banks, or is it another regional bank situation? Where do you see some of the issues there?
Leslie, your questions are spot on. Let me answer you in two parts. First of all, in terms of the higher interest rates combined with increased regulation, that is going to put more pressure on a credit crunch, because banks are going to be very reluctant to lend to different sectors. So that is going to worsen the prospect for a recession. Second, your question as to where it starts from. To begin with, I would still stay with the so-called smaller banks, $100 billion deposit and in the neighborhood of that. But you will also see, I think, some of that spread over, if not in terms of an actual failure, a sharp push downward in terms of bank equity prices. So where will the Fed have to come and rescue? I would say smaller regional banks to come to bring them to give some support. But the bigger banks are also eventually going to need some form of help from the Fed, maybe in terms of quantitative easing, lower interest rates, which helps the bigger banks as well. So the quick bottom line to your question, Leslie, start with smaller banks, but the bigger banks are not out of the woods at all by any means.
Sri, it's interesting. I mean, there is this budding debate about whether or not the Fed put is gone for good, and you clearly don't think it is.
I don't think it's gone at all, Carl. I think the Fed put is an ever-present reality for the U.S. and world economies. Time and time again, with the fact that they push up interest rates, then they find that they pushed it up too much, and then the system crashes, then they come in, they ease, they cause the next cycle. So that has been the history of Fed policy, not stability, not steady economic growth, but constantly creating more cycles. So I don't think that has changed at all.
All right. Komal Sri-Kumar, thank you for your perspective. Appreciate it.